Hello and a warm welcome to Talking Stocks. I'm Gugulethu Cele. Now today in studio joining me is Biddlecombe and Liam Hechter, both from Anchor Capital. And we're talking the Walt Disney Company, commonly known as Disney, an American diversified multinational mass media and entertainment conglomerate who reported their third quarter earnings recently. Gentlemen, good to have you with us today. When I think Disney, gosh, I think first image I have in my mind is probably Mickey Mouse. And then from there you start thinking about all the other cartoons and movies that they've established over the years. But just exactly how big is this entity, Henry?
So it's massive, Gugu. It has a market cap of $160 billion. I'm assuming there are a lot of parents watching this show who will tell you that you can just close your eyes and buy Disney. You don't need to explain the investment thesis to them. But it's been in our portfolio for a number of years, and it's actually been an exceptional performer. It's returned capital growth over the last 5 years of 23.5% per annum, as compared to the S&P 500, which has returned in the region of 11% per annum over the same period. So it really has outperformed the S&P 500 materially. But it's quite a complex business, and really it consists of four primary divisions, and the first of which is also the largest. It's the media and networks business, which accounts for roughly 54% of operating income, and that consists of the ESPN Sports Network, the Walt Disney channels, A&E, and ABC, which is now being rebranded Freeform. The second largest division is the Parks and Resorts, and that's the one we're all familiar with.
Yeah.
That's Disney World in Florida, but they've got 2 parks in the States, 1 in Europe, and 3 in the East, the latest of which is just opened now in Shanghai in China. The third division is the studio entertainment division. It's also a very exciting one, and that's where they really house all of their IP. They own the Marvel Comics portfolio there, they own the recently acquired Lucasfilms portfolio, as well as the Pixar studios and obviously the traditional Walt Disney franchises like your Beauty and the Beasts. And then the last division is the smallest. That's really the consumer products and interactive division, and that's really their licensing department, where they will charge licensing fees for merchandise producers to produce Disney-related merchandise. And each one of those divisions currently faces somewhat of a challenge for various reasons, and I think what we want to do today is to discuss each one of them and ultimately end off with an investment thesis as to why we think Disney is a buy.
Perhaps before we do get there, from an operating income perspective though, which of those segments is the largest contributor?
So certainly it's the media and networks division, and that comprises 54% of operating income. Now of that 54%, ESPN actually makes up about half. Now ESPN faces a rather interesting sort of existential challenge at the moment, because ESPN really sell their content to your traditional MVPDs, or what they call the multi-channel video product distributors. And I guess one would compare that to our DSTV. And essentially the formula is consumers pay $50 or $60 a month for a bundle of channels, most of which they won't want. And their subscribers peaked in 2013 at around 100 million, and they've been slowly eroded, and it now sits at about 88 million. And they now need to transition to streaming and content on demand, a la Netflix. And I think there's been a lot of investor skepticism around how and if Disney will be able to make that transition successfully. So one of the big announcements that came out of their third quarter earnings was the acquisition of a third in a company called BAMTech. And I actually think Liam knows a little bit about the business. He can explain the rationale to you.
Thanks, Henry. So what they've done is to try and sort of continue sort of with the business of ESPN. So obviously ESPN is the US's version of you would compare that to sort of SuperSport in South Africa. So they house a lot of the sports rights and content that gets sold onto the cable networks in the States. And to sort of continue the life of ESPN, what they've had to do is sort of pivot into offering a streaming service. So basically delivering that content in a different form to the end user. And in the recent set of results, as Henry mentioned, they took a third stake in a company called BAMTech, which is a sports streaming company. So effectively, they are making their move now into streaming and basically delivering sports content to the end consumer via the internet. And over the last sort of 3 years, as cable networks have experienced the pain, ESPN have as well, as people are cutting cables and moving towards streaming device or services like Netflix and Amazon Prime, I think it is. Yeah. And over that time, ESPN has also sort of ridden that wave and has suffered with them. So it's good that management have indicated their sort of proactive ability in innovating and delivering the content in a different way to the end consumer.
As you say, clearly a vote of confidence in management, looking at future opportunities to take advantage of there. But what would this mean overall for the current metrics of the company from a valuation perspective? Is it still sitting pretty? As you alluded to, it has managed to perform significantly well over the last few years, though, Henry.
It has. Look, Media Networks is the biggest division, but it's also the slowest growing. So we need to look at the other divisions. So, for example, with resorts and parks,
yes.
On June the 16th, Disney opened their new Disney theme park in Shanghai. And by all accounts, it's been a runaway success. They've had over 1 million visitors through the gates in the last 2 months. To put that into context, Disney World in Florida get about 52 million people a year through the gates. So it's not game changing, but it's certainly material. And then the third division, the studio entertainment division, is actually what has resulted in Disney's stellar run over the last 5 years. And what they've done is they've acquired these very expensive portfolios of IP. For example, Marvel Comics in 2009 for $4 billion. And Lucasfilms, which is obviously the Star Wars franchise, in 2012.
And we know how big that is, right?
We do, especially Liam. They bought it for $4 billion. But they've been able to monetize these quite successfully. And they've grown the business from about $600 million in operating income up to $2.5 billion by the end of this year. So that's compound growth of 30% per annum. And they've also increased that business's operating margin from about 10% to 29% over the same period. And what that's done is it's dragged Disney's overall operating margin up from about 24% to 29%. And that's why, although revenue's only grown at about 7% per annum, earnings per share have grown at a rate of about 18% per annum. But the problem with that is that we're starting to see the impact of base effects. Disney's gotten so big now that growing over the next few years is going to be a real challenge. And we think that the company faces a period now of consolidation. And you've seen that. You've seen the share price start to react to that, where historically the shares traded at a 15% premium to the forward PE of the S&P 500, but that's inverted lately, and it's trading at a 7% discount to the S&P 500's forward multiple. Liam, I don't know if you want to comment on that.
Yeah, I think a lot of the concern around the business is obviously, as Henry's alluded to, the fact that they've grown so much over the last sort of 5-6 years. You know, they are currently victims of their own success. And I think that the market is a bit skeptical as to whether they can replicate that. Now, at the same time, you've got an ESPN business who's structurally at the moment currently going backwards, although, you know, the management team at Disney have been proactive in the acquisition of BAMTech and the move towards streaming. I think that investors are going to have to be patient. You know, the developments at BAMTech, you know, it's a $1 billion acquisition, or dollar acquisition, sorry. And the Disney management are going to have to continuously develop and invest more capital into growing and developing that offering. They're going to be the first to market with sort of a premium sports content streaming service. There are currently other services, but I think Disney through ESPN are going to try and build out something truly world class. And I think that it also needs to be mentioned that as the films have done so fantastically well over the last few years, and grown as sort of a lot faster than the rest of the business, they now form a much bigger portion of the operating income. And our films are going to typically, sort of by their nature, be quite a lumpy form of income. You know, at some periods you're going to have films that do incredibly well, and there's going to be quarters where you know the film isn't going to do as well as people expect. And I think that as films become a bigger portion of the earnings mix, investors are going to have to accept the fact that the earnings are possibly going to be lumpier in this business. And while the return profile should over the long term remain quite high, there might be an extra, it's not cyclicality, I wouldn't use that word, but I would definitely use the word lumpy. And the sort of short-term underperformance is probably going to become sort of a prominent feature in results over the next sort of 5-6 years.
What about the confidence levels that you have in management, given the fact that they have been able to identify, you know, potential acquisitions which could boost the business? Are we still fairly confident in their leadership?
I think it's worth mentioning that they have a fantastic management team, and I think Henry will unpack sort of where that goes over the next few years, which is currently a little bit uncertain. I don't know if you want to...
Yeah, look, I mean, Bob Iger's led the company for many years, and he's obviously responsible for Disney's stellar run over the last while. And there are succession concerns, and it's something that gets brought up on every earnings call every quarter. And the board have been a little bit mum on the issue, but they said, look, it's under control. We're not under any pressure, and we're confident that we'll find a worthy successor. Bob's not in any rush to go anywhere. In terms of management's ability to continue to innovate and deliver growth on such a large base, you know, there's an interesting statistic. So since Disney bought Pixar Studios in 2006, they've produced 29 films. Now, on average, each one of those films has generated $800 million at the box office. Now, to put that into context, the record box office film globally is $1.2 billion. So these are very successful films, and they produce them consistently. And that it's a vital part of the business, because a successful film feeds the other businesses, because it drives offshoots into the theme parks business, into the merchandise business, and at a later stage into the TV business as well.
Yeah. Sounds like interesting dynamics at play, but let's find out now whether to buy, hold, or sell Disney. Liam, let's start with you. Buy, hold, or sell Disney?
Buy. I would definitely buy Disney. I think it deserves a spot in the portfolio, and I'll sort of unpack it briefly. And I think that the brands have got an incredible moat around them. I think that there's a strong management team, and over the years, sort of Disney's demonstrated an ability to outperform and continuously innovate. I think at the moment sentiment might be against them as a result of themes across the world like cord cutting or cable cutting, and that feeds into the sort of Netflix argument. But I think that the Disney management team will continue to sort of make sure that they're not behind the curve on this. I don't see Disney becoming another Nokia or BlackBerry. I think that they'll be able to maintain.
Especially for kids out there. To close off with, Henry, your view?
Yeah, Gugu, I would agree. For me, it's a buy. You know, growth is slowing, but the company is still going to grow earnings at around 10% per annum, we feel. You know, on a discounted cash flow valuation, we derive a fair value of $115 a share, which represents around 18% upside from where we are today at $97. And then on a relative outlook, you know, I don't think that Disney should trade at a discount to the S&P 500. So at the very least, I think that discount should close. So you've got about an 8% re-rating waiting in the wings. And on top of that, you've got another 8% in earnings growth. So that, again, represents around 16% upside. So, you know, an attractive equation for me.
So clearly no need for us to take the mickey out of the stock.
Nope.
That pun is intended. But we'll leave it there for today. A buy recommendation coming through for Disney from both my guests, Henry Biddlecombe as well as Liam Hechter, both from Anchor Capital. Be sure to join us next time, though, where we talk more stocks.